Hey guys, good afternoon and welcome to this festive special of MF Corner. I'm Pavitra, with me is Sonal, and as we get closer to Diwali, we want to help ensure that you have a prosperous and profitable new year. So today we're going back to basics. We're looking at understanding how you can really start your investment journey from scratch. So how do you create well-diversified, both medium and high-risk portfolios, and how should you approach mutual fund investing in the current setup and amid these sky-high valuations? In fact, our guest today is someone who's been in the market for several years. She's seen the cycles, and Sonal, I'd be very interested to know what are her, top learnings, top lessons from the market as well.
Oh yes, and it's always good to get expert advice, especially at times like these when people are all there to have a profitable Diwali. So on that note, let's welcome Radhika Gupta, Managing Director and Chief Executive Officer at Edelweiss Asset Management. Radhika, always a pleasure listening to you and to get your expert opinion as well when it comes to investing across all the asset classes. So as Pavitra said, let's start at the very beginning. How many funds do you think one should have to create a good, well-diversified portfolio once they start?
Great question, and firstly, wishing all the viewers in advance a very happy festive season. May it be just prosperous and more prosperous Diwali and the rest of the year, and hopefully the rest of the decade. I think in terms of funds, these days this question is so relevant because I see funds, portfolios, believe it or not, with even 100 funds, 200 funds. And I actually think most consumers need between 8 and 12 funds. The math I tell people is 4-5 core categories of funds, a few in equity, maybe one in international, one in debt, and 2 funds of different AMCs in the categories. That's enough diversification. I mean, 8 to 12, in my view, is really tops. One way you can think about how to do this is to think of your portfolio as core and satellite. So 80% of your portfolio is what I call dal chawal, very basic funds, things like multi-cap funds, balanced funds, etc. And if you want to do any experimentation, it's within that 20%.
Okay, so 8 to 12, funds in your portfolio. Radhika, it's a pleasure having you on. And, we also encounter this so often when people write into us with their queries where they just have too much, they have their money spread across too many funds because they don't know which one to get into. But let's also try to tackle the different needs. So for someone, say, who's a high-risk investor, they're looking for a long period of time and they want to take a slightly more aggressive view. How would you split these 8-10 funds? What categories would you get into?
So I think even firstly, the highest risk of investor, even the highest risk should have a contingency fund. Often people assume a high-risk investor does not need contingency money and can be an equity. I don't buy that because there are periods when equity goes through very meaningful drawdown. So if you're a high-risk investor, build out your contingency fund, and that you can use arbitrage funds. They're great for contingency. So that is that. The rest of the portfolio in a high-risk investor's case will be, of course, equity. I think in today's scenario, you need a fairly balanced split between large, mid, and small cap, especially if you are high risk. There was a school of thought that said equity investing meant the core was large cap and you had a little bit of flavor of mid and small cap. I do think if you look at the composition of the economy today and the decade forward, then large cap will not give you an accurate representation of the Indian economy. Many sectors and themes that will emerge, China plus one, chemicals, capital goods, manufacturing, diagnostics, capital markets, our mid and small cap themes. And even our mid and small cap companies, our average mid cap company is 30,000 crore market cap, small cap company 12,000 crore market cap. So in short, you need a portfolio that is large, mid, and small. I think multi works really well, multi-cap as a category for most investors. And you can supplement it if you want with additional mid and small cap exposure. You can pick up, if you're a high-risk investor, a thematic fund, like, we have a recently listed IPO fund. I always feel new age companies are a very interesting space. But essentially multi-cap plus a couple of other things. If you're a sophisticated investor, you can also throw in an international fund. So I've given you a sense of what the core should be and some satellite ideas.
Oh no, that's very interesting. And you spoke about the mid and small cap companies, the chemical companies. Once they were small and a lot of them have become large as well. So that's where the growth story could be as well. But Radhika, if we do the same exercise, say for a medium risk profile, how would you alter the split?
So for a medium risk profile, first I would add a component of fixed income. There's contingency, and then you can add a component of fixed income. Now the problem is, and because a medium risk profile person essentially outside of contingency has a combination of equity plus fixed income. With the taxation rules, however, it is better to do this in the context of an asset allocation fund. So I'm a medium risk profile investor. For me, what works is a nice hybrid fund as my core. So like a balanced advantage fund. You want to be a little more aggressive, you can choose a aggressive hybrid fund that's 75 equity balanced debt. So you get your fixed income and basic equity allocation from there. And I would certainly supplement this with a little bit more mid and small cap exposure. Maybe if you want a little more international exposure. That's what I do for my own portfolio. I consider myself a medium risk investor. So these are the kind of classes that work. If you're not comfortable with hybrid funds, you can of course do multi-cap and fixed income separately. But I do think hybrid funds just are a lot more tax efficient to solve this.
Okay, so we've discussed how you can go about constructing a portfolio if you're a medium risk profile or a high risk. But Radhika, we've been talking about the mid cap, small caps, and this entire space has been so hot. We've seen a huge flow of money into these categories as well. And we've been speaking to fund managers. And I think at some point, they're just telling us that it's too much to invest. They don't know where to put in this kind of money. Do you think it's just thrown valuations off completely? And for someone getting in today, do you think it's better to wait for a cool off? Or do you think that, if you're investing for the long term, if you're going via the SIP route, for example, it doesn't matter much and you should just start?
So I don't buy, I think the answer is somewhere in the middle. I don't buy the narrative that, valuations are super stretched. In fact, we run popular mid and small cap funds, and I think we're in the middle of the valuation cycle and in the early days of the earnings cycle. That's not to say that select names don't have pockets of frenzy. That can always happen. But the whole category, to call it stretched, I don't think it's fair. A lot of this narrative that has emerged about mid cap and small cap over the last few months, especially small cap, is because certain MFs or certain AMCs have shut funds for flows. Now, I don't think you should read into those actions because those AMCs have individual reasons. It could be a particular liquidity related challenge. It could be the fund size of that particular scheme, but many of us keep our funds open. So I wouldn't read too much into that narrative. I still repeat that I think mid and small cap exposure is essential. Now, should you load your entire portfolio with mid and small caps? No. One approach, as I said, is to move to multi-cap, where you're not staying out of mid and small cap, but you've got 40% large cap exposure also to balance. The other point of view, you asked about market timing. I think investors in general do a fairly poor job of market timing. And this, question of should I enter now, should I wait, is almost a little bit futile. What we've observed is anyway, if you're entering these funds via SIP and your time horizon is 7 to 10 years, your XIRR is very reasonable. I mean, I'll give you a small example. We have a fund that was launched in November 2007, which wasn't the greatest time to launch a mid-cap fund. But reality is, despite the fund having an 80% drawdown, an SIP investor has probably made a very meaningful CAGR, well in excess of 14-15%. So time, in my view, in the market is far more important than timing.
That's sane advice, of course, and that's something that should be considered while investing in any category. But the next thing, Radhika, which is quite new that's happening in the industry, is SEBI considering a new high-risk category of funds. What are your thoughts on this? How much do you think the minimum allocation should be, or if you say that somebody should be allocating some amount here?
Well, I think it's too early to speak. The concept in general is a very good concept. I think it's a very progressive idea from the regulator to allow this notion of a high risk category, where you can be a lot more or a little bit more experimental in terms of ideas. There are, of course, certain categories and ideas that AMFI and the industry would have proposed to SEBI, and I'm sure we're deliberating on it. And I'm sure this high-risk category will come with a certain set of constraints. For instance, if something like credit is allowed in this high-risk category, then perhaps, it will be in closed-ended form. I'm just wagering a guess. If something like unlisted is allowed, then maybe it will be in closed-ended form. So I think it's too early to tell. How much to invest is certainly very early because we don't know the contours of what is going to come out. But remember, it's a high risk category. It's going to come up with a higher minimum. So it's also for a certain set of investors. So I would just say to the large mass of investors, don't jump at this. Your basic products actually do a great job of solving your problem.
Okay, got that. And that is, I think, where things currently stand is that the AMCs have been, told to submit their recommendations in terms of what, what the minimum allocation should be. Radhika, just another question on, this entire market cap situation that we have been studying. What do you think of the microcap fund? There's one microcap passive fund in the market. So do you think that's a good idea? Will we see one from Edelweiss as well? And do you think when you're looking at, small caps, mid caps, microcaps, is it a good idea to go the passive way, or do you think, you want a fund manager handling your money?
So, I mean, I run a active and a passive small cap fund. And if you asked me by bias, and I am not into these active passive debates. On the small cap side, I really do believe active fund management is the right route. The small cap index is 250 companies, and it's truly a very wide index. And in small cap, something like management quality is extremely important. There is a high mortality rate. Governance standards and disclosure standards are actually not the same as large cap companies. So I think small cap is about really stock picking and bottom up analysis. And over the long period, I think active management works in small caps, and I think the funds have generated enough alpha to prove that. Now, as far as micro cap is concerned, firstly, you have to remember that let's see what we call micro cap. In India, we have a rank-based definition. 1 to 100 is large cap. The next 150 is mid cap. 250 onwards is actually small cap. Now, we think of small cap as 250 to 500. 500 to 750 is probably a micro cap, and then there are funds after 750 also. India probably has about 800 companies with a market cap greater than 3,000 crores. Even if you look at industry small cap funds that are actively managed today, they have a component of that micro cap class. Companies above that 500 in rank. So it's not that you're missing on micro cap exposure by not investing in a micro cap fund. In fact, the traditional small cap fund has a dominant component of companies between 250 and 500, a little bit of mid-cap companies, and some dose, usually 10-15% of what you call micro caps. Some funds are actually even far more aggressive. We are not, but for risk reasons, but some funds are. So you already have that exposure. As far as launching a fund in the micro cap category, I don't like to say never, never say never. But I think we would want to understand liquidity very well. And we are very selective in the timing that we launch these funds. So trying to launch the funds in a period of frenzy is often something that we don't like. In fact, we're known for launching NFOs quite at the bottom. And I would rather stick to that track record. So we are evaluating, but liquidity is really paramount to us.
Oh, yes. And there's been so much traction in that particular space. As you said, frenzy is what we are seeing in this particular segment. Radhika, it's a lovely chat, but we have to take a quick commercial break. When we come back, we'll continue our discussion with Radhika Gupta on mutual fund investing and a lot more in the new Samvad. Stay tuned for that. Welcome back. You're still tuned into MF Corner. This is our Diwali special episode where we are trying to get expert opinions to understand how you can actually make your portfolio for the new Samvat and have a profitable festival as well. Radhika, we've spoken about what you consider good as an investment profile, what number of funds that there can be in a portfolio. But what would you say is the top lesson that you have got from the market? Some learnings that you can share with us.
Oh God, there are many of these, but a couple. I think the one that I always like to start with is that investments are very personal. And in these times, there is a lot of FOMO. And in FOMO-driven investing, I'll do something because someone else did it. I saw someone else making money trading this. And, it causes you to do things that are out of your comfort zone and don't really work for your risk profile. And I always say, remember, investing is personal. You're not in a horse race about money. Money should truly be about goals. So focus on yourself, focus on goals. I think that is extremely important. The second these days is sort of just going back to simplicity in financial products. There's always a temptation when mutual funds do a very good job with many things to say, ab aur kya? Can I get something more exotic? Can I get something more different? And the reality is, even as your net worth increases, you don't need a more complicated answer. In a country like India, the index does 12%, average mutual funds, do much more than that. So you don't need to look for complicated answers. And very often in looking for complicated answers, we pay higher fees, we sacrifice liquidity, we get into things that we don't understand. So that I think is important. And the third and final one, which is the time-tested advice, is really about time. Again, it's such a noise-driven world that it's very important to zoom out and ignore the noise. Otherwise, you tend to make far more short-term decisions. And if you really give your decisions and your investing time, I think they age well, like fine wine. So time in the market, just giving the market time and its process is extremely important.
All right, very important lessons there that I'm sure all of our viewers can, take note of. Now, Radhika, we want to know up till date what has been your best investment and also what has been your worst. But we'll start with the good part. So what do you consider your best investment so far? It doesn't have to be a mutual fund. It could be a mutual fund, a stock, an asset, a house, anything.
Best investment is twofold. Best investment was my education. I went to Wharton on financial aid and on loans, and I'm still reaping the benefit. So I think the best investment is actually can never be in a financial one. It has to be that. And second best, and the other best investment, not second best, is of course relationships. So money is a great investment, but finally an NAV can never give you the happiness that real things can. And worst investment, I don't think I've had a single worst investment, but I did some very bad investing in my early days in 2007, where I just over allocated to equities, and that ended up being very bad for me in 2008 when the market corrected and I had to redeem to do my startup in 2009. So that was really bad. It was just bad asset allocation. It was not a bad investment. It was bad asset allocation.
Okay, so asset allocation, of course, is very important. And take your point in the first advice, Radhika. Some of the returns are intangible. You really cannot calculate how much benefit that they've given to you. So thank you for that. But what would your advice to a young or new investor be? Because we are seeing a lot of different generation or Gen Z, so to say, who's coming and joining the stock markets, or they are very new to the investment category altogether. What would you tell them?
Get educated and then get started. I think there are a lot of young investors. In fact, I go to so many different forums, meet people from sort of many stratas of society, and I ask them to raise their hand if they've heard about an SIP, and that's usually most people. But if they've started one, and then unfortunately it's 10-20% of people. So I think know, and then invest and grow. And I think the good thing that is there today is that investing is very accessible. Many young people feel they need to have accumulated a very large corpus to start investing, when the reality is, it probably costs you a couple of 100 rupees to buy a lipstick or to buy a cup of coffee, but it takes 100 rupees to start an SIP. And the reason it's important to start early is not just long-term compounding. The reason it's important to start early is that you learn the game early on low basis, so that by the time you have real income, you're making better decisions.
Okay, take that point. And what are you expecting from Shark Tank this time around? I just wanted to understand, is that something you're looking forward to? And
maybe that will be a good or the top financial investment.
Well, I hope I do make good investments, but I am super excited about the opportunity. I think it is finally what I do is a celebration. What I do as a mutual fund CEO is also finally a celebration of entrepreneurship. We invest in markets, we invest in funds, but funds invest in companies, and companies are the story of India's entrepreneurs. I think Shark Tank is an opportunity to see India's entrepreneurship in its early days, up and close. And from the little I've done so far, well, I can't say very much. I think just being on that set and seeing those stories is so incredibly inspiring. I mean, you feel very good about the future of both the country and the country's entrepreneurship. So I'm looking to invest, but I'm also looking to learn, to contribute, to add value, to add advice. I think in some way light a candle in a small way.
Okay, absolutely, as you do whenever you appear on our shows and give your expert opinion to our viewers as well. Radhika, wishing everyone at Edelweiss Asset Management, to you and your family, a very happy Diwali. And thank you so much for joining us today. With that,